Hey guys, in this video we will be going over liquidity and bias on a chart. So let's begin. So what is liquidity? Liquidity is basically areas where the stops is put in, or areas that is unfilled in the market, such as a fair value gap. So why is liquidity level important? Liquidity level is what draws the price to, and this is the kind of information we use to determine our bias on a chart. In trading, we are not trying to predict where the chart's going to go. What we are trying to do is be reacting to what the price is going to do, instead of trying to predict where it's going to go. For example, looking at this moment, where do you think the chart is going to, or where the price is going to? As you can see here, the price is either going to a previous high level, or it could go into a imbalance right here. So where do you think it's most likely to go first? So we have to determine our bias in the chart. As you can see, it is closer to the previous high level. So the chart will take that out first usually. As you can see, the high was taken first, and then the market dropped into the imbalance right here. Showed a sign of resistance and continued lower. So where do you think the chart's going to go next? Next liquidity level. Since we are on a live market right now, I'm not able to play out the chart for you. But if you could look at the time and date, what I did today, you could see the market will eventually hit the second liquidity level. Let's look at this new example right here. Let's draw out all the liquidity level. As you can see, the lows, the highs, the next high, the highs after that. You could draw all the liquidity level, because every single one of these levels are very reactive, so you should draw them out. You don't want to be predicting if the chart's going to be bullish or bearish, because you can't. You could have a bias though, if the chart's going to take out this first, or this first, or this first. You could also draw out the imbalance on a chart, because the market usually reaches for a liquidity level. Both the imbalance and the highs and lows are liquidity level, because there is usually stops placed here, or the fair value gap has price that is unfilled. As you can see, there is some resistance right here before the price start reversing. There is some resistance here, and the market reversed to take out the highs. As you can see, every single one of these level hit, there is resistance. We have in this moment we have a breaker block, which this might support price. And our stops could be below here. And I will probably target the liquidity level of the fair value gap. And let's see a chart play out. As you can see, it did work here. As you can see, it did work here because this breaker block is supporting price right here. As you can see, the candle did not close below the breaker block. The market eventually hits the high level right here. In this video, what you would have learned is that you would be looking at the chart for liquidity level in determining your bias of whether or where the chart would be going. As this liquidity level is taken, the market shows sign of it trying to go lower. What you would be doing at every single one of these high level is that the chart has enough volume to go higher, or if the chart displaces below this level, it means that a reversal might happen. Be sure to watch my other video to get more information on taking an entry on the chart.